trading literacy, market trends, chart patterns, technical analysis, trading strategies. If these words sound like a foreign language, you're about to become fluent in the next 30 minutes. Most traders lose money because they're missing one crucial skill that separates winners from losers. Today, we're fixing that forever. Welcome back to the channel. Today, we're diving deep into trading literacy, the foundation every successful trader needs, but most never learn properly. Trading literacy isn't just about knowing what a stock is or how to place an order. It's about understanding market trends, reading price action like a story, and making decisions based on data rather than emotions. Think of it this way. You wouldn't drive a car without learning traffic rules, right? Yet millions of people jump into trading without understanding the basic language of markets. That's like trying to read a book in a language you don't speak. By the end of this video, you'll understand how to read market trends like a professional, the 3 types of market movements that control all price action, simple indicators that actually work, the psychology behind every market move, a powerful strategy that can transform your trading approach, so grab a pen and paper. We're about to unlock the secrets of market literacy that traditional education never teaches. Let's talk about the elephant in the room. Why do 90% of traders lose money? It's not because they're unlucky or because the market is rigged. It's because they lack trading literacy. Most people think trading is about picking the right stock or cryptocurrency. They see someone on social media showing off profits and think, I can do that too. So they open an account, throw money at whatever's trending and wonder why they're losing. Here's the reality. Trading without literacy is like performing surgery without medical school. You might get lucky once or twice, but eventually you'll hurt yourself. The biggest misconceptions I see are, first misconception, I just need to find the right indicator. Wrong. Indicators are tools, not magic wands. It's like thinking a hammer makes you a carpenter. You need to understand what you're building first. Second misconception, more trades mean more money. Actually, the opposite is true. Professional traders often make fewer trades, but with higher probability setups. Quality over quantity, always. Third misconception, the market is unpredictable. While you can't predict exact prices, market trends follow patterns. Human psychology doesn't change. Fear and greed drive the same behaviors they did 100 years ago. Fourth misconception, I need expensive software and multiple monitors. Some of the most successful traders use simple setups. It's not about the tools, it's about understanding what you're looking at. The real problem isn't the market, it's the gap between what people think they know and what they actually need to know. Today, we're bridging that gap. Now let's build your trading literacy foundation. We'll start with the basics and work our way up. Understanding market trends. Every market movement falls into one of 3 categories. Uptrend, prices generally moving higher. Downtrend, prices generally moving lower. Sideways trend, prices moving within a range. Think of trends like rivers. An uptrend is like a river flowing uphill. It takes energy to push against gravity, but once it's flowing, it tends to continue. A downtrend is like water flowing downhill. It follows the path of least resistance. Here's a simple way to identify trends. Look at the peaks and valleys. In an uptrend, each peak is higher than the last, and each valley is higher than the previous valley. It's like climbing stairs. Even if you step back occasionally, you're still going up overall. Support and resistance. Imagine you're bouncing a ball in a room. The floor is support. It stops the ball from falling further. The ceiling is resistance. It prevents the ball from going higher. In trading, support is a price level where buying pressure typically emerges. It's like a trampoline. Prices bounce back up when they hit it. Resistance is the opposite, a level where selling pressure appears, pushing prices back down. Here's the key insight. These levels aren't random. They form at prices where traders made emotional decisions in the past. When prices return to these levels, similar emotions trigger similar actions. Volume analysis. Volume is the fuel behind price movements. Imagine 2 scenarios. A stock goes up 5% on 100 shares traded. A stock goes up 5% on 1 million shares traded. Which move is more significant? Obviously the second one. High volume confirms that many traders agree with the price movement. Low volume suggests the move might not last. Think of volume like applause at a concert. Loud applause means the audience loves the performance. Quiet applause might mean people are just being polite. market psychology. This is where trading literacy becomes powerful. Markets are driven by human emotions, fear and greed. Understanding this gives you an edge because emotions are predictable. When prices are rising, people get greedy. They start thinking, what if I miss out? This fear of missing out pushes prices higher until they become unrealistic. When prices are falling, people get scared. They think, what if I lose everything? This fear creates selling pressure that pushes prices lower than they should be. Smart traders recognize these emotional extremes and trade against them. When everyone is greedy, be cautious. When everyone is fearful, look for opportunities. Simple indicators that work. Let's talk about 3 indicators that actually help. Moving averages. Think of these as the market's average opinion over time. A 20-day moving average shows the average price over the last 20 days. When current price is above the moving average, the trend is generally up. When it's below, the trend is generally down. RSI, Relative Strength Index. This measures if a market is overbought or oversold. It's like a thermometer for market emotions. Above 70 usually means people are too excited, overbought. Below 30 means people are too scared, oversold. MACD, Moving Average Convergence Divergence. This shows the relationship between 2 moving averages. When the lines cross, it often signals a trend change. Think of it as a conversation between short-term and long-term market sentiment. Candlestick patterns. Candlesticks tell stories about market psychology, and each candle shows 4 pieces of information: opening price, closing price, highest price, and lowest price. A green candle means prices closed higher than they opened. Buyers were in control. A red candle means prices closed lower than they opened. Sellers were in control. The body of the candle shows the difference between open and close. The wicks show how high and low prices went during that period. Long bodies suggest strong conviction. Short bodies suggest indecision. Long wicks suggest rejection of those price levels. Risk management. This is perhaps the most important part of trading literacy. Risk management is like wearing a seatbelt. It won't prevent accidents, but it can save your life when they happen. The golden rule: never risk more than you can afford to lose on any single trade. Many professionals risk only 1 to 2% of their account on each trade. This means if you have $10,000, you'd risk no more than $100, $200 per trade. Position sizing is crucial. Don't put all your money in one trade, no matter how confident you feel. Diversification isn't just for long-term investors, it's for traders too. Market cycles. Markets move in cycles, like seasons. There are times of growth, spring and summer, and times of decline, fall and winter. Understanding these cycles helps you adjust your strategy. Bull markets are characterized by optimism, economic growth, and rising prices. Bear markets feature pessimism, economic contraction, and falling prices. Sideways markets show uncertainty and consolidation. Each cycle creates opportunities for literate traders who understand what to look for. Now here's the game-changing insight that separates amateur traders from professionals. Successful trading isn't about predicting the future, it's about managing probabilities. Let me share a powerful strategy that embodies this principle: the confluence trading method. Instead of relying on one indicator or signal, you look for confluence, multiple factors pointing in the same direction. It's like being a detective gathering evidence before making a conclusion. Here's how it works. Step 1, identify the trend. Is the market in an uptrend, downtrend, or sideways? This is your foundation. Trade with the trend, not against it. Step 2, find key levels. Locate support and resistance levels where price has reacted before. These are your battlegrounds where supply and demand fight. Step 3, wait for confluence. Look for multiple signals agreeing. Price approaching a key level, volume confirming the move, RSI showing overbought, oversold conditions, candlestick patterns confirming sentiment. Step 4, enter with defined risk. Only enter when you have at least 3 confirming factors. Set your stop loss before you enter and know your profit target. Step 5, manage the trade. Follow your plan. Don't let emotions change your strategy mid-trade. Here's a real example. Imagine a stock in an uptrend approaching a support level. The RSI shows oversold conditions, volume is increasing, and you see a bullish candlestick pattern. This confluence suggests a high probability bounce. The beauty of this approach is that you're not trying to be right all the time. You're positioning yourself where the odds are in your favor. Even if you're wrong 40% of the time, you can still be profitable if you manage risk properly. This is what trading literacy really means. Understanding that markets are probability games, not certainty games. You're not trying to hit home runs every time. You're trying to get on base consistently. Let's recap what we've covered in your journey to trading literacy. Foundation level. You now understand that trading literacy is the language of markets. Without it, you're trading blind. Trend analysis. You can identify uptrends, downtrends, and sideways markets. You know trends are like rivers. They tend to continue until something changes their direction. Support and resistance. You understand these are psychological levels where emotions drive trading decisions. They're not magic lines, they're areas where supply and demand battle. Volume and psychology. You know that volume confirms price moves and that markets are driven by fear and greed. Understanding crowd psychology gives you an edge. Practical tools. You have simple indicators that actually work. Moving averages, RSI and MACD. You know they're tools, not crystal balls. Risk management. You understand that protecting your capital is more important than making money. You can't make money if you don't have money to trade with. The confluence method. You have a professional strategy that focuses on probability, not prediction. You know to wait for multiple factors to align before taking action. Remember, trading literacy isn't something you master overnight. It's a skill that develops over time with practice and experience. Start small, focus on learning, and gradually build your confidence. The market will always be there. There's no rush to risk large amounts while you're still learning. Think of your early trades as tuition for your market education. If this video helped you understand trading literacy better, smash that like button and subscribe for more educational content like this. I want to hear from you in the comments. What's your biggest challenge in understanding market trends? Are you struggling with technical analysis, risk management, or market psychology? Your questions help me create better content for everyone. And here's your homework. Practice identifying trends on any chart you can find. Start with the weekly time frame to see the bigger picture, then zoom in to daily charts. The more you practice reading charts, the more fluent you'll become in the language of markets. If you're ready to take your trading education to the next level, in day trading, check out my video. I tried day trading and this is what happened. I'll link it in the description below. And info card above. Remember, every expert was once a beginner. The difference between successful traders and those who give up is persistence and proper education. You've taken the first step today by improving your trading literacy. Keep learning, keep practicing, and I'll see you in the next video.